Today's number is 4,000. Why? Well, it could be that people are losing faith in the system faster than we even thought. And our favorite trade of the last 2.5 years is going absolutely ballistic. But could this just be the tip of the iceberg? Dark pools are on the rise from Wall Street, and we're starting to see huge options commitments at a critical zone. Positive gamma or negative? Are we going to sell off in September? And many other questions answered in today's video. So let's break down what Wall Street are doing and not what they're saying. Stocks, commodities, and cryptos. We've got a lot to discuss, guys. See you in a moment. Well, welcome back, everybody, to The Daily Show. My name's Thomas Atkinson, and in today's video, we have a lot to discuss as always. What's going on in the macro world? What about the data flows? And more importantly, it could be all down to Wall Street's biggest moves of the last couple of sessions. We saw risk on in sectors that weren't that hot only a few weeks ago, and it looks like things could be heating up into September. But I want to discuss with you first off a really damning statistic on the economy. And this is where we're going to have a difference between the economy right now and actually the market itself. And remember, it's very important to be able to delineate which one you should be trading, which one you should be investing in, and of course, what you actually need to be doing in the future. So first up, a statistic we've never seen before. Even during the depths of the global financial crisis, we did not see subprime auto loans this high. A new all-time record. 60-day loan delinquency rates are absolutely skyrocketing on cars across the US markets. And I'm sure this is happening in pretty much every country in the world right now. Why? Well, people just absolutely overcommitted themselves on loans back in 2022. And this is in broader daylight to what we've already been discussing through many other basically debt-fueled markets, whether it's from people refinancing their houses and then actually borrowing against them and spending that money, or it's even people just saying, you know what, this car, take it, I don't want to know about it, and going bankrupt. It seems like there are problems in the economy itself, and it's showing up, of course, in the jobs numbers. Now, it's not actually that you're going to necessarily lose your job right now that's the problem. It seems to be, if you have lost your job, how difficult it is to get one back. Another record since the start of this survey has just come through, and it's now easier actually to keep your job than it is to, of course, go and find a new one. And this is a big difference to where we were only a few years ago. Remember when everybody was saying, please come to our company? Well, those days are absolutely over. From 2013 to all the way to now, we have not seen a jobs market quite like this one, even during COVID, during the 2020 levels. So there's clearly a weakness in the markets, and this is showing up as a lead indicator through the JOLTS and construction spending reports. Remember, we've already announced this basically about a week ago on the channel. By the way, if you're new here, welcome to the channel. Make sure to subscribe, hit that bell icon. We cover markets like this, stocks, commodities, and cryptos every single day. But this is a really big statistic because, of course, when construction people stop leaving their jobs and looking for new ones, it is a concern. It means that we're very smart out there, guys. We know that the jobs market is starting to weaken, and we know also that it may be more importantly to keep security right now than to possibly go out there and try to find something new. Why? Well, it's probably to do with AI and also just to do with a weakening economy. But we do know that the jobs numbers are now the only thing that the Federal Reserve is thinking about. Basically, the Fed usually has a dual mandate. Inflation, don't worry about it. Now it's all about the jobs numbers. So will they be cutting? The answer is quite simply yes. And you'll see how that may play out to either a huge advantageous level in the markets over the next 6 to 12 months, or possibly even the beginning of a recession. So what are Wall Street actually doing? Well, you may think based on those jobs numbers, based on what we're seeing in the economy, that they'd be like panicking. Well, they're not. They're absolutely buying into pretty much the American consumer. You can see here consumer discretionary stocks are going back up again. Now, XLY is a bit of a weird one because it's made up of course, a very heavy concentration in two stocks. One of them being Tesla, which is now, by the way, just all they're going to talk about is AI and robots and nothing about cars, I would think. And the other one is, of course, what we've got going on with Amazon, which with the recent tariff changes on the weekend seems to be potentially getting a bit of flows. So this is leading into quite a large rally in the most important sector for 1/3 of the US economy, which is obviously consumption. Now, why does this matter? Well, we track this using codes such as this: XLY, consumer discretionary, versus XLP, consumer staples. And it's very important to note that whenever you're looking at markets, guys, you need to be looking at something like this chart to really see if it's risk on or if it's potentially risk off. Because when it's risk on, you have to generally be looking at rotation, looking at the best sectors in the world, and of course, the best stocks in general. It doesn't really matter what our opinion is of the markets and the economy. It's more important to actually focus on the flows. We've got some excellent charts coming up in today's video to discuss that, including those dark pools. So we did a survey on YouTube and we did a survey over on our X account, and we found with the question of how much longer will the stock market bull run go on for, most of you guys were either in a very short period of time we're going into a recession, less than 12 months, but a few of you actually believe that it will never end. So that the Federal Reserve and everybody will just keep printing money into oblivion. So I kind of agree with both of you guys. But what I would say is it's funny how 1 to 2 years was so much lower. It kind of makes the contrarian in me think, well, maybe that's actually where the problem lies. We're going for a little bit longer still. And that's all going to be because every single one of the firepower levels will be used by the American government and obviously the Federal Reserve. Tax cuts, done. Federal Reserve rate cuts incoming. Problems with inflation in the future, probably going to be there. And on top of all of that, QE. So you've got to remember, we still have a couple of things in the tank. And you might say, but Tom, QE's already been going on behind the hood. You would be correct. It's actually liquidity. And liquidity has been on the improve for the last kind of 3 years, ever since the lows of 2022. So the markets are certainly doing what they are showing, but not necessarily what the media is telling us. So just remember, right now, a lot of people are confused, and the rise of people searching gold, the rise of people searching recession, the rise of people searching bubble is here. So what this usually is indicative of is generally the late cycle of a bull run. And that makes sense because generally you go about 4 years in any sub-bull run itself, which would take us into 2026. So let's take a look at the here and now. There are a couple of things that are happening. One, we got the largest trade ever recorded on VOO, which is a huge S&P 500 fund, back on last week. Now, since then, we've actually traded around this level a couple of times, and it just so happens to be around that really critical zone of course, 6,500. Now, why is that important? Well, it just so happens that this is where we have a pinning effect of huge options that are sitting all over this zone. Now, next week, if you're not aware, is the OPEX. That is the options expiration, the biggest one of the month and arguably the biggest one of the quarter, because most people know that September is considered the worst week or worst month of the year. And actually what statistically tends to happen is after that expiration, we can see sell-offs in markets. But will that be the same this year? Because of course, around that point, we're going to get a most likely interest rate cut from the Fed. Well, let's have a look at what they're doing, not what they're saying. So first up, a couple of big transactions coming in on semiconductors, which may actually be purchases themselves. You can see here TSM going back up now to those all-time high levels and getting a massive dark pool trade on top. Now, it could be that this is a sell, but we've got to remember that over the last couple of months, what's been happening? The market has been going sideways. This is what we call a pit. Now, over the last 24 hours, we saw a big uptick in risk on assets, and a lot of those were Hood, AppLovin, all of these types of stocks that were just included into the S&P, and generally just hype across the board came back over the last 24 hours. Let's have a look at a couple of other things that have been happening. Number one is treasuries are starting to come back alive. Now, you guys know that I haven't been a big fan of treasuries for a while. I've been saying, you know what, they're not a trade, they're more of an investment. You've got to have like multi-year time frame analysis on them, and I still kind of match that. But a couple of big trades came through over the last 24 hours, 61, 44, and 45 all clustered together, and it kind of suggests that there's a little bit of activity. So we'll have a special on this moving forward, and this is of course on the 3 times levered long treasuries position, but there's, I think, a change in the air here. So treasuries will come back into our daily show moving forward into the end of the year. It's now time to start talking about it again. Remember, often we take these things out when they're boring, when they're accumulating or distributing. The reason we do that is because when everybody's on something, you don't usually want to be on it unless you're in early. And then you ride that thing all the way to the sun. However, when everybody hates something and it starts to improve on the charts, that's when we want to be paying attention. Remember, if it's in the press, it's generally in the price. What about the yen? So this is, of course, Chinese stocks. They've been seeing a bit of dip buying in recent times. We've, of course, liked Chinese stocks for about a year and a half now. And you can see here that dark pools have started to come back out. And I think that's kind of notable. In fact, when I look at HSI, which is the Hang Seng, it looks like it's got flow momentum into the positive direction. So certainly Hang Seng does seem to be improving, and that is, of course, a positive sign. Now, you might be thinking, oh, should I get into the market? I'm feeling FOMO. Oh, wow, I need to get back in. I need to run it in. You can probably pump the brakes still. I mean, statistically, we look to be in a very up, down, and all-around market. And although markets can sometimes make a high into the OPEX in September, it's pretty normal for a third-year kind of market, especially post-election markets, to see a high right around the middle, as you guys can see here, and that then it sometimes sees a bit of a sell-off. Now, I don't think it's going to be a crash because we don't have problems in the bonds market yet, which we are tracking very closely here on the channel, but it does make sense. Remember, we thought coming into year 3, which is right now, that we'd be up, down, and all around, and I would argue that's exactly what's happened. We sold off massively, over 10%. Of course, we thought 10 to 15, ended up getting almost 20. And then we've seen one of the fastest recoveries on record. So, if you actually take the year-on-year gains right now, they're not as good as you would maybe think they are, unless you're looking at particularly some tech. In fact, I just checked gold today, and it was like year gain is like 40-something%, which is just absolutely incredible. So congrats if you've been on that one, or even silver recently. Now, what about the Fed rate cut? Well, this is probably where things will change. The structure of markets will change as well. A bullish market coming off a Fed cut, it depends on the sectors. A bearish market coming off the Fed cut, especially the next 3 to 6 months, we could be entering into a recession. What the market will do, not what people are saying, is going to be super important. And remember, to sub to the channel, we'll track this one very closely together. It's going to be super important to track this as much as we can. What about the Fundstrat's opinion, which is obviously Tom Lee's? Well, he's obviously going with the bullish side, which is that he believes a SEP cut will actually give us a year-end surge. And that is certainly a plausible scenario. Again, it's going to be which sectors are going more than anything else. And I would say we've got to follow the trend. But will it be actually a later sell-off? Now, Wayne Whaley, who brings up some amazing data, has gone through and he's found that when you have a pretty good summer, which obviously it was a pretty good summer, 5% summer, June to August period in the US, then actually the more likely sell-off zone is October. And this is what we get into when we talk about these Q3 periods. We tend to see this kind of August, September, October bring the pain. And it turns out that only 6 of these periods in October are actually bullish over this particular read. Now, I think that's a very interesting statistic, and it actually brings up 23 and 24 again for where the second sell-off was. It wasn't in September, which is now too well known maybe that it is a sell period. It was actually October. But I wouldn't get your hopes up about, an epic collapse or anything like that, although take a look at this one. That was 87. that would be pretty nasty right there if that happened. But it is an interesting stat nonetheless. Anytime you're getting a market that is hugely more bearish than bullish in statistics, and that's something I always look at, because remember, the market is rigged a little bit towards the bull end. So when you look at something like a 20 to 4, well, in similar cases where we sold in October, September, whatever, we generally always rallied up. So you can see here that it was a very bullish statistic when it came to generally buying it up. Now, why could this be true? Well, some of